I would now like to introduce today's presenters. Michael Janssen, Chief Research Officer, guides the practice's research agenda and architecture by leveraging his extensive experience to identify and unlock emerging trends. David Ricard, Vice President, leads Everest Group's sourcing and vendor management and customer experience management services offerings for EMEA clients, as well as select global accounts. Anurag Srivastava, Vice President, is a member of global sourcing team and assists clients on topics related to location optimization, benchmarking, and global service delivery strategy. Ricky Sundrani, Vice President, is a member of the pricing assurance team and assists clients on topics related to price benchmarking, solution review, and contract assessment for IT infrastructure, ADM, and system integration services. And with that, I'd like to turn things over to Michael.
And thank you. Hello, everybody. Today is an interesting conversation we're going to bring to you. Largely, if you think about COVID is now, kind of pushing to the back of our agendas, both personally and business-wise. It's still there, but it's pushing toward the back, and we're now confronted with energy-related issues. We're confronted with supply chain issues, but most importantly, for our industry, we're confronted with labor shortages. And these things are not simple issues to solve. And so what we're going to do today is I'm going to show you some European. We're going to show you. This is all about Europe, but we're going to start out with a U.S. view of the numbers here because they're so dramatic. And so what I want to do is take you first to a slide here that's really based on our JOLTS report. So it's our job openings that are in the marketplace. And to best read this chart here, look at the orange as being the unemployment line. The blue line represents the number of job openings. And normally you have more unemployed people looking for fewer job openings. But as you see there in the big spike there in the US, we lost 16 million jobs in the US marketplace. Today, we've reversed out almost entirely, not completely, but a good portion of that. And we have 8.4 million unemployed. But what's changed dramatically on the spectrum here is the fact that largely the job openings have exploded. So we're looking at 10.9 million job openings, which is 3.3 million higher than any previous pre-COVID highs, with a net of being 2.5 million job openings today, more than there are people looking for work. So that creates this big supply-demand imbalance in the marketplace, something we've never seen before, and something that's going to be challenging for all of us going forward here. So this gives you a dramatic view of the U.S. marketplace. David, we talked about looking at a Euro view, and the numbers there are a little bit more muted because of some of the way the numbers are collected, but talk to us about what you're seeing there as well.
Yeah, thanks, Michael. So yeah, what you can see on the chart on the left-hand side of the screen is the EU, the UK, and the US numbers. And I think what stands out there is that the EU and the UK didn't see such a high increase in the unemployment rate as the US did. And I think that's mostly driven by the fact that across Europe, there were a lot of job retention or furlough schemes, but also different employment laws in each country, which meant really that people weren't laid off to any extent. And what we're seeing, though, is that the EU and the UK curves actually do follow each other quite nicely. Well, actually, we've seen it sort of returning to almost to the levels of unemployment that we saw pre the financial crisis, and not even pandemic impacted, but actually unemployment levels are getting back to where we were before the financial crisis. The chart on the right is just focusing on the EU job openings. And what we can see there, again, we haven't seen this sharp increase that maybe the US have seen, but we have seen an uptick in job openings in the EU. And we're now getting back to pre-pandemic levels for job openings as well. And an interesting fact is from a UK perspective, for the period of June to August this year, the UK did report over 1 million job openings, which was the highest number since records began back in 2003, being reported in that way. And the pandemic low was about 340,000 job openings. So in the UK, we have seen a significant number of job openings over the last few months. So we're watching this carefully. because I think as we're seeing that students are returning back to university, giving up summer jobs, but looking for jobs, the furlough scheme in the UK, for example, finished at the beginning of this month. We are looking closely at the numbers to see where that goes.
And it's impacting all sectors of your economy, or many sectors of your economy too, is right? I mean, from a perspective of, you know, some of the fuel crisis that you guys are dealing with on a real-time basis.
Yeah, no, it's hitting all sectors. I think we're seeing definitely an upsurge in retail in terms of what we're seeing is competition for jobs that would normally go into contact centers or into BPO, as things like the direct-to-consumer companies or the big online retailers are really attracting talent with high wages. So there's competition for talent across the board, and we're definitely seeing that in the UK, but also across Europe. Okay, so let's look at it in terms of the things we care about in the services marketplace around the labor shortages. And so one of the indicators we have, there's several things we're going to go through here, but one of the macro indicators is the attrition rates. And so we asked the question just recently here in August about how the attrition rates are changing relative to where they were in the previous 3 months. And what you're going to see here is that attrition's way up 10.5 points. So that's a huge change for a relatively short period of time. And so this is creating again, that going back to that supply demand, when you start to have that imbalance, then you start to say, hey, people can look for new opportunities and they start to leave. And so as attrition starts to rise, that's going to create a set of inflationary impact, or as people look for, the reason they're going to leave is they're going to get more money somewhere else or better job conditions. So that creates a set of dynamics that are inflationary in nature. And then, Ricky, we started to look at that in terms of the context of what was that doing to the rates in the outsourcing industry. So one is the salaries and the salary ranges, but then that has an impact in the sourcing marketplace as well.
Thanks, Michael. So very pertinent. So the counter question that we tried to ask and understand was, are you having discussions about increasing rates on existing contracts? And because we were kind of party to some of these conversations, we've been having a lot of, we've been supporting a lot of clients on similar mandates. So we knew these conversations were definitely happening, but didn't really fully appreciate that service providers were actually actively requesting increases in nearly 66% of the existing outsourcing, out of which 43% is something which is still an ongoing situation, whereas 12% are already there where they've got some sort of a rate increase. Now, I know we have many industry veterans on this call in the form of Michael, David, and Anurag, who can vouch for the fact that they've never seen a time when a conversation has kind of changed so quickly from a from a cost reduction to a cost increase in so many situations, right? And so quickly. This industry has traditionally and always been built on cost takeout and process improvement, right? They always find ways to lower costs on a year-on-year basis. So however, the whole talent demand supply problem and this price increase is a complicated problem like that requires a very multidimensional challenge, right? And is no longer only about high-end talent. So that's going to require some creative solutions to power through it. I think the next question again, we wanted to do a deep dive in terms of what are the areas where we're seeing most of these pricing increase requests coming from, right? And unexpectedly, and we weren't surprised by this, we were actually seeing the highest pricing requests coming in the IT ADM space and the CXM space. There are a couple of reasons that we thought would be true because why this is happening. So at the peak of COVID, CXM was also an area which saw the maximum pricing pressure. So now rates bouncing back up in this sector is not unfounded for. Now, new app dev is an area which is kind of seeing the highest price increase request, right? As enterprises embrace cloud, agile, DevOps, which has led to a huge demand supply gap, resulting in high attrition, resultant wage increases, and thus resulting price hikes. Similarly, CXM is an area which has seen a very, very high level of interest, right? Because of wage inflation leading to an increase in the provider's cost going up. As CXM plus couple it with the fact that historically the margins in the CXM business have historically been quite low, and thus providers are kind of just trying to pass on some of the cost increases to their clients by increasing rates. In fact, we were involved in one situation where the client came to us as a subscriber client came to us saying that one of our CXM providers has sent us a request to increase rates by as much as 30%. And we were kind of helping them navigate that, deal with that kind of a situation.
Yeah, Ricky, when I look at this and I see 2/3, as you showed on the previous page, 2/3 of clients are actively having discussions about rate increases. And then I look at the magnitude and the scale of these price increases. This is shocking in terms of our industry. We've never seen anything like this before. We've had little bitty increases, but not like this. So when you look at this, this is really kind of a conversation on this one about the amount of automation that can be put in play here. You see a differentiation from the top to bottom here. Any quick thoughts on that?
Definitely, Michael. So let's look at IT infrastructure world as an example, right? So we're not seeing the same level of intensity on the IT infrastructure services side, as majority of the contracts in that space are still output based or resource unit based, right? Where providers, even though they are subject to cost increases, but they are leveraging other levers such as higher offshoring, higher automation, pyramid optimization, and other levers to kind of manage some of these increasing costs, right? And thus they're able to keep their overall prices in check. In the ADM world, similarly, the answer could lie in accelerating the move to DevOps way of working, which could kind of result in a better TCO down the line. I think the key is really to establish a baseline, right, and see where you lie in the market spectrum, right? So if you're too low on the market spectrum, and then probably you should anticipate or expect a rate card increases. It is bound to happen sometime sooner or later. However, if you baseline and you see yourself that you are already at the upper end of the market spectrum, then probably the answer could lie in the fact that you could try and negotiate harder with your vendors to not have those rate increases passed on to you.
Ricky, there's a question here in the chat. Are these price increases can be attributed to COVID? And my first answer would be, well, and probably there's some of those that may be attributed to some shortages there, but the bigger issue is really demographic in nature, changing trends in the workforce that are more cultural in nature. But I think COVID might have been the match, but the fuel or the underlying trends were actually much bigger and broader than COVID.
Correct, Michael. I think I would largely agree to that. I mean, these conversations kind of got delayed last year, but I think inherently as enterprises accelerate their digital transformation journey, and majority of these transformations involve a major play around application development, DevOps, and some of these new ways of working. We definitely anticipate the prices to only go up from here for some of these next gen digital skills. And we have a section later on talking about what specific areas of the market are we seeing price increases on, and what's the future outlook looking like.
Yeah. So Anurag, talk to us about a geo perspective on this.
Sure, Michael. So the geo angle actually reflects what we have discussed on the overall demand supply gap from a talent perspective, right? So you see that because you're seeing much more of that gap in the US and unemployment rates are quite low, you have a higher increase being requested, for example, in North America, right? We all know that the India market also is in the middle of a huge jobs boom, right? So startups are booming, lots of companies are putting up their GBS, centers there, providers are expanding. So it's sort of, leading to that talent scramble in India as well. And that is why you see that reflected in the kind of rate increases being asked for. So these two sort of mirror each other more closely. Whereas, if you look at the situation in Western Europe, including the UK or Eastern Europe, or even Latin America, potentially even rest of the world, the situation is a little more subdued. We'll need to watch this trend though, because some of these may actually filter down even to the rest of the world. But right now there seems to be a proper differentiation between these set.
Yeah. All right. So this represents the kind of the macro trends. Let's move into some of those key attributes of the IT and BPS outsourcing market in Europe. So let's take it down a level, specifically focusing on the Euro region.
Yeah, thanks, Michael. And I think when we look at it from a global perspective, what we're seeing is that Europe has maintained its share of both the outsourced deals that are going on over the last 3 years, as well as the GBS, so Global Business Services Centre, so in-house or captive centres, when you compare them to the US or other markets. So there's a lot of data on this chart, but I think the main takeaways for me is that obviously EMEA or Europe has maintained its position there. What we have seen though is that based on the H1 numbers for 2021, it is looking like the total number of outsourced deals may decline slightly when compared to 2019 and 2020. But for GBS, based on the current run rates, it does appear that the number for 2021 may actually increase compared to 2020. So we're definitely seeing a lot more in-house central GBS centres being set up. And it may not be a surprise that there was a suppression of the movements in 2020 as enterprises were dealing with getting a workforce up and running and weren't able to sort of look at things such as travel, in getting new centres up and running when they were just worried about getting their workforce to say working from home and operational and compliant. So we're definitely seeing an increase in GBSs being set up, and the outsourcing deals are slightly down on previous years. On the next slide, we break it down into a bit more detail, and we start looking at within Europe specifically. And so when we look specifically at Europe, what we've seen is that over the last 2 years, Western Europe has had the largest share of both outsourced deals and GBS centre setups. So that's where a lot of the activity is being driven. If we look at the outsourced deals, the numbers remain relatively flat. So although that's similar to the global picture, again, the H1 2021 numbers are showing again a decline in the number of outsourced deals that we are expecting, and that's expected to continue for the rest of this year. Again, for GBS setups, both in the UK and Ireland and the Nordics, we've seen a decline in GBS setups, but Western Europe has seen a big increase of up to 10 percentage points of an increase. So again, Western Europe has really been the engine room for driving a lot of this growth of GBS centres. I also would say that sort of the number of deals in H1 2020 is showing that this year could see more new centres being set up than in 2020. And again, this mirrors the global picture. So we're seeing a strong picture in 2021 for GBS, whereas outsourcing is flat or declining slightly.
Yeah, but David, we're seeing 2021 is going to be a year or two different halves for outsourcing. We're seeing a lot of activity right now. I mean, I don't want anybody to think we're seeing a decline if you look at the last year, part of the year here.
No, you're right, Michael. I think there's going to be lots of activity. I think a lot of the deals will end up being struck at the end of this year or beginning of next year. So I think when we look back at 2021 numbers, we may see the numbers are slightly down, but that's because people have obviously been stabilizing, getting their business back up and running, and then looking at outsourcing in the future. And these deals obviously do take a long time to strike, do the contracting and then implement. So yeah, we're not expecting a massive decline in outsourcing. It's just that this year the numbers will be slightly down. Yeah,
okay, but it's really a year of two halves.
Yes, in terms of activity.
Yeah. So I can take up the breakdown of the GBS activity done by European enterprises. So these are centers set up by European companies in a captive context or in-house model, right? So shared services delivery. And you can easily see that there is a preference for Europe delivery, right? So look at all centers set up through the years, Europe dominates that. I think that sort of flipped maybe 10 years back. Before that, all of these companies were expanding in offshore markets in India, in the Philippines, and elsewhere. And in recent times, we've seen increasing share of Europe delivery, just given the benefits of nearshoring, right? And that has led to a lot of the growth in Central Eastern Europe, as all of us know. Couple of other comments to call out. One, as you can see, the share of Asia Pacific actually increased in H1 2021. So we believe that is driven by a lot of the cost pressures that have come back to bite. And then that is in some ways related to the topic for today, which is the rate discussion, right? So a number of these enterprises faced with dire circumstances, revenue pressures, cost pressures, expanded in Asia Pacific to optimize their cost of operations. So that is one. Second, if you look at the delivery landscape, Central Eastern Europe remains fairly strong, and that has been driven by a desire of these companies to diversify their portfolio, given the exposure that they had during COVID and the experience that they had in that period, where a lot of the delivery could not come back online after that initial break. Thirdly, I wanted to call out the key delivery destinations. I think in the Asia Pacific and North America, I think it is more the usual suspects that you see that are being favored for delivery, whereas in Europe You see a mix of Eastern Europe as well as Western Europe. So you see the usual suspects like Poland, Romania, Lithuania within there, but also increasing instances where delivery is being set up in France or Germany, UK, Portugal as well. Either as a measure to diversify your risks and delivery and portfolio, or set up centers of excellence for something that is requiring higher order talent, higher value talent, which you find in some of these Western European geographies. If you look at so this is just a sort of small sprinkling of deals that we wanted to highlight, right? And these are the big deals, the outsourcing deals on the left-hand side of the page, and the key or big GBS center setups on the right side of the page, right? So if you look at, and I'll not go through each of these deals, but a couple of things that I picked up, right? So one, you can already see a skew towards digital deals. So you see a lot of cloud data center, for example, in the CGI Hansel deal. You see electric vehicle technology in the Conduent and UK DOT deal. You see orientation towards smart vehicles in the Porsche, GBS setup. You see cybersecurity, mobile. You see AI ML in the Bayer setup, right? So you see a lot of that orientation towards digital services delivery continues. The other thing I picked up is that you also see some impact of talent challenges, interestingly. So if you look at the CLO deal with Novo Nordisk, it is for providing talent acquisition services, right? Which essentially bears the fact that we are seeing in the market, which is around increasing talent pressures and demand supply gap.
All right, so Anurag, let's take it down a level. Let's take it down into, I think you've broken it down into 3 regional views.
Right. So if you look at if you look at the trends within the GBS setup activity, right? So this page essentially profiles the service provider center setups on the left side of the page and the GBS center setups on the right side of the page, right? So essentially these are setups done in the Europe region by companies headquartered anywhere, right? And so we wanted to basically profile how different regions of the continent are witnessing growth from a delivery standpoint, right? So number of key takeaways, right? So if you look at overall, the GBS activity is higher just from the numbers. Service provider activity has been muted. Even historically, GBS activity has been higher, and that sort of points to slight orientation, rotation, or strengthening of the internal model, or at least companies firing on both cylinders, right? So that's one. Secondly, if you look at the share of Central Eastern Europe, like we were discussing a while back, that is going up both in the service provider model as well as in the GBS model, right? So you see that happening. This is a result of a combination of factors, most notably the desire to optimize costs of operation. So rather than delivering your work out of Western Europe or your headquarter regions, putting up in Central Eastern Europe and delivering to the entire European region, right? The other is most of the Central Eastern European geographies, including Poland, Hungary, Czech Republic, Lithuania, Romania, they have seen maturation. So the talent is now able to even address some of the more complex problems, both on the IT side, BPS side, engineering side. So you see that as another reason. The third angle I picked is that we see a lot of our service provider clients diversifying in the region, especially the Indian heritage companies that have not been as strong as some of the European peers in this region. So they are now realizing that they are too concentrated in India, the Philippines, or other offshore markets, and they're now, driving growth in the Central Eastern European region. Finally, on this page, if you look at the GBS activity in H1 2021, especially, it has been more fragmented. So that is again a sign of GBS, portfolio being diversified, and we see that with a lot of our clients as well. A number of these companies have already been fairly strong in the Central Eastern European region. So now, as they start to diversify, they're now actually bringing some work back home or back to the home country, but maybe in a tier 2 city. So, for example, while some company may have a delivery presence in a Poland or a Romania, but they're now bringing some of that work to a Manchester in England or a Belfast or a Glasgow to diversify that and also tap into some of the regional local talent pools that are being able to work from anywhere or more broadly remote delivery.
Thanks, Anurag. I think on this slide, what we wanted to do is just try and have a look at where the activity is coming from. So, of all the new centres that are being set up, who's driving the activity, and what we can see here for H1 2021, the vast majority of new centre setups are coming from GBSE. So, those global business services, those in-house centres, the captive centres, are driving much of the activity. They've always had the lion's share, as you can see, from previous years, 66, 77%, but in H1 2021, it's 91% of the activity, which may be no surprise because I think service providers have been very focused on understanding what the future of their operating model looks like, how they deal with their existing real estate versus looking to set up new centres. So largest proportion of the activity is coming from GBSEs. The second chart, the one underneath that one, starts to look at, okay, where's the activity coming? What are these functions of these services, these GBSEs doing? What's the activity they're doing? And what we can see there is that BPS is 20% of the activity, IT is 13, but by far the largest area around the functions the centres are doing is around engineering services. I think that this will equalise out, and as Michael said, I think that we're seeing it will be a year of two halves. And a lot of this activity will equalize back out. But that's what we've seen in terms of the activities, which is engineering has been the one that's focused mostly on the new centre setups. And there's been a decline in both BPS and IT. When we start looking at the locations that are being used in Western Europe, I think none of those locations on there will be a surprise to people that have been around the outsourcing world for a while. I think what we're finding quite interesting is places like Paris or Dublin or even Barcelona that are typically a bit higher in price are still very popular because obviously they have such a ability to attract a wide range of talent. And one of the main reasons for this webinar today is to talk about the challenges we're facing in talent. So I think both service providers and enterprises are willing to sort of look at that extra little premium in terms of the price to be able to attract the talent that they're going to need. But Ricky, it'd be interesting. I mean, what's all this doing to the rates that enterprises should be expecting to pay?
Absolutely. Thanks, David. So at an overall level, if I look back at the last 6 to 8 months, the rates for commodity IT BPO services have largely been stable in Western Europe. However, looking at all of the things that we've discussed in the past 25 minutes, the outlook is certainly inflationary across majority of the services. If you look at what has happened over the last 6 to 8 months, the commodity services, traditional services like legacy infrastructure services, service desk, Java, C++, traditional ERP related skill set, even some of the commodity BPO work like transactional F&A, procurement, insurance and banking back office, these have largely been flat or have kind of increased only marginally. However, the areas where we're seeing kind of an increase in rates would be the new next-gen areas, including like topics like cloud, cybersecurity, SRE, cloud ERP related platforms, IoT, blockchain, and even something around category sourcing. And we'll briefly touch upon that, why category sourcing is an area which is kind of an increasing interest in the recent times. Now, if I talk about the future outlook, however, we again anticipate more or less a similar trend to continue for some of the traditional and legacy skills. However, in area and we continue to expect a premium for skills around cloud, cybersecurity, SRE, DevOps, cloud native full stack development. These are areas where we're seeing significant traction and a lot of uptake in market activity, especially around DevOps and cloud native full stack development. So Western Europe, the organizations in Western Europe have generally been slightly behind the curve. I wouldn't say far behind, but slightly behind the curve in terms of embracing cloud. Now, not to say that they've not adopted cloud, but it's just that the organizations in North America now have kind of adopted cloud, and now they've started to leverage some of the more cloud native services, right? It would be right to say they're in somewhere in phase 2, right? They've moved all of they've started leveraging IaaS. Now they start thinking of PaaS and cloud native services. The Western European counterparts are still kind of maybe they are at the end of phase 1 or just graduating into phase 2, where they've started leveraging some of these cloud native services around containers, be it AI ML related technologies on cloud, even big data and computing, quantum computing use cases. So these are areas where we do definitely anticipate a significant price increases in the coming 6 to 12 months. On the BPO front, again, for traditional services, transactional F&A, procurement, insurance, banking, back office, we kind of expect pricing to remain steady. However, areas around complex F&A, voice-based customer support, those are expected to kind of show some increase. Even functions such as financial crime or anti-money laundering, which traditionally enterprises prefer to retain in-house, they've gradually started looking at outsourcing some of these functions, which has led to kind of an increase in increase in the pricing for some of these skill sets. And I think the most premium rates that typically commanded in this space would be the ones who are process experts. As enterprises embark on the digital transformation, as they continue to embark on digital transformation initiatives, digitalization and automation of processes is one of the key initiatives, and that's why they're always on the lookout for experts who are hands-on on process consulting, or have very industry-specific process consulting skill sets, or they could be experts on Lean, Six Sigma and related technologies. We probably would want to look at a similar point of view around the Nordics as well. And Anurag would kind of take it forward.
Yeah, thanks, Ricky. So if you look at the Nordics, again, this is the first point to call out is it's a very small part of the overall delivery footprint in Europe, right? So probably about 5% of deals over the last few years, even in 2021. And this has been because of higher cost of operations in this market, as well as relatively smaller talent markets compared to Central Eastern Europe, even some of the Western European countries. We still see that some of the growth here is being driven by either desire to do more higher value digital oriented work, where there is some talent in this market, as well as if there are products that are cultural in nature, or you need the local knowledge and affinity, and you need a certain level of command over the local languages to be able to deliver that work. We're seeing that growth here. Overall, from a delivery model perspective, you can see that pretty much all of the growth in new center setups in the region in 2021 was driven by the GBS model, and generally they have had more mandate to play in a higher cost location, right, to be able to justify that kind of work portfolio. The other is, if you look at the functional split, engineering tends to be doing better. It has maintained a high share, but like is consistent with other parts of the region, we see a spurt in engineering activity. And again, some of this is driven on the back of electric vehicle technology, battery technology, some of the newer age and next gen kind of skills.
Got it. Now, looking at some similar pricing trends on the Nordic front, Nordic firms generally have been faster adopters of outsourcing and cloud in general, and we've seen that manifest itself in the form of big centers that some of the Indian players have established in that region, or the large client base that they have in that region. So it's not uncommon to see enterprise clients in Nordics already talking about some of the next gen technologies like software-defined infrastructure and containers as part of their renewals with vendors, right? So we also believe that Nordic enterprises, Nordic countries are going to be amongst the first to roll out 5G, which could lead to a spike in rates for resources skilled in related technologies such as edge computing and connected platforms. The other story is kind of largely similar to Western Europe, right? Prices continue to remain steady for commodity work, legacy infra, digital workplace services, traditional applications, voice-based contact center, F&A, procurement, and so on. Another key characteristics is that the Nordic BPO market is kind of characterized by a presence of a large number of localized vendors, not necessarily the larger players, but a lot of local vendors. And they seem to be kind of taking up the majority of the market share in that market in the BPO space. We will want to have a similar view on the Eastern European market in the coming slides.
Yeah, thanks, Ricky. And I think that there's not a lot to say on this slide, to be honest. I think it mirrors a lot of what we've seen in the Nordics and also Western Europe. So largest proportion of new center ownerships is coming from GBSEs, the same as we've seen in the other pictures. And again, engineering services are driving a lot of the activity with a decline in IT and BPS. So similar picture across all of the three regions, I think. In terms of when we look at locations for this region, I think Poland and Romania are still the leading two sort of destinations. We are seeing lots more interest in Vilnius in Lithuania. I think that's an area that we've seen more and more conversations happening about. But the traditional ones in both Poland and Romania are still leading the way. Again, Ricky, can you give us a bit of a view as to what that's doing on the pricing?
Sure, David. So on the Eastern European front as well, we're seeing an increased proliferation of local high-end digital and emerging players in the Eastern European market, right, who are known for doing high quality work and probably at a lower cost as compared to doing the same work onshore, right? So one of the driving factors for this is adoption of agile, right, which has kind of led to an increase in demand for nearshore resources based in the same time zone, especially in the application development area. So we anticipate pricing to go up by 2 to 5% in the contact center space, in the BPO space in the Eastern European market, as this was also an area which saw the maximum pricing pressure last year. And now due to automation and wage increases, CXM market is kind of witnessing some rate hikes. Another trend that we've observed in the BPO market, right, and where we're seeing premium pricing be commanded is on the RPA front, right? So increasing number of RPA implementation projects in Europe are now being driven from nearshore rather than driving them from offshore, right? Because this is mainly to offer better time zone overlap, which becomes critical, right, as involvement of the process owners at onshore becomes imperative. The otherwise on the story on the IT front is similar, right? We definitely anticipate the skill sets around cybersecurity, containers, cloud native, AI, ML to be the top priority areas for enterprises going forward.
Okay, fantastic. So, there's such dynamic behavior happening in this marketplace. It keeps everybody on their toes. And so one of the things that's always the best for us is if we have an opportunity to showcase some of our more detailed data that you can't do in a webinar, we're going to open up a little quick poll here. And if you're interested in getting a deeper dive on what we call an IT or diagnostic on the IT infrastructure services spend, you can see some of the dimensions there on pricing, location, mix, offshore, SLAs. Go ahead and click the link. We're also going to make offer, we don't have a slide for it, but also make an offer on the rate analysis. And if that's something that you'd like to have a conversation with Ricky and Anurag and David on the team, in more detail, just click the link and we'll be in touch. We'll have your email and go from there. All right. Very interesting stuff. Again, I think we're at a pivot point in this industry. It's hard to say exactly where it's going to take us. But let's move into some of the things we're seeing, some of the innovation in some of recent deals. And David, talk to us about this from a sourcing procurement perspective. David, you're on mute.
Sorry, Michael. Yeah, someone had to do it today, and I guess it had to be me. So yeah, I was on mute. Yeah, so I think from a sourcing perspective, I mean, what you can see on that chart there is that these are the sort of the 5 leading selection criteria that procurement and enterprises would use when selecting service providers. And I think pricing and commercial competitiveness hasn't changed. It's been the same. I've been involved in outsourcing and procurement for probably nearly 20 years now, and that's always been a key driver. I think the one thing that we're seeing more and more interest in, and I think it's been driven by the pandemic partly, is the focus around compliance and security considerations. So as enterprises were getting their workforce and service providers were getting their workforces working from home, there was an increased concern around security and compliance. So that's really ratcheted up in terms of attention, but it's not overtaking pricing and commercial competitiveness, because that's always been the number one criteria and probably will be for the foreseeable future. But just one other thing to say there is, I think what we have seen is that, and I think it goes back to a point Anurag made earlier, we are seeing European enterprises more open to dealing with the Indian IT service providers than maybe they were in the past. And so because they're looking for rapid digital transformation, and they're taking advantages of the opportunities being presented by the pandemic in terms of maybe their business has shifted, or actually they're having to address challenges caused by the pandemic. So they're looking to shift their digital transformation quickly, and I'm more willing to work with the IT Indian service providers than ever before. But in terms of the key focus from a procurement perspective, then pricing commercial competitive stays as number one. Ricky, I think you're going to cover how the enterprises are funding it.
Sorry, yes, David. So I think to continue this conversation, right? So digital transformation is a given, right? But the question is, how do you fund some of these initiatives? So you might have seen some of these to be fairly common in our earlier presentations as well. But I think the key is that these have been prevalent in the North America market for some time now. However, we are increasingly seeing some of these initiatives even in the Europe market in recent times. For example, innovation fund has almost become table stake in almost all mid to large size deals where providers may park a part of the fees, say 3 to 4% of the deal value as innovation fund to be utilized for projects outside the BAU activities. Again, this is becoming very common in EU focused deals. Even front loading of transformation benefits, right? And this is an increasingly common practice where providers are trying to front load the benefits of transformation into year 1 and year 2 itself, which could then lead to some cash optimization, which could then be used for funding the digital transformations. So yeah, we kind of anticipate more and more of this to happen in the Europe market in the coming months and years. Another topic that we probably want to cover on the next page is really around financial engineering, right? So while the overall cost narrative does not change and we are seeing price increases and demands increase in spikes in everywhere, the question here is how do you, the question here is how do you kind of financially engineer those better, right? For example, amortization of upfront one-time investment, one-time transition fees has almost become so common in the market that almost every deal we are seeing enterprises demanding that the transition fees be amortized over the first year or being amortized over the 3-year deal term. Similarly, a new tactic we've seen in recent times is around offering a deal bonus, which could be to the tune of 1.5 to 3%. Again, not very common, but more common becoming more common in the North America market. But relatively, we expect this to also become common in the Europe market. This is then tactic used by service providers in high competitive intensity situations. And similarly, there are deals where providers are trying to smoothen out the fees by kind of trying to financially engineer it in such a way that their overall cost does not go beyond what they're already paying. And we've been in situations where, let's say, the client was getting into a major transformation initiatives and the year 1 cost was actually higher than what they were currently paying in-house, right? So the client asked the provider to financially engineer the cost in such a way that their year 1 cost does not look higher than what they're currently paying, right? So it become a net positive or a net neutral kind of a situation for the client to get the board convinced to sign the deal. So some of these peculiarities are becoming increasingly common in Europe-focused deals as well.
Ricky, let me bring in a question here. We've got pages and pages and pages of questions here, and I'm going to try to insert them along the way. We've got a question around new technologies driving rate increases make sense, but how aggressive are service providers in using automation to take the pressure off workforce increases? So in other words, we're going to see these salary increases. I don't think those are going to go away because of the labor shortage, but what are service providers doing to really, are they really pushing the automation to try to mitigate the impact?
Part of the answer is definitely yes. They're definitely trying to work on those initiatives as we spoke about earlier. So driving more automation, moving to the DevOps world. There are definitely some of the initiatives that providers are trying to do to kind of overall reduce the so the P part is definitely going up, right? As Michael, as we've discussed multiple times, but the Q part is where they're trying to pivot or kind of reduce and optimize, so as the overall net cost for the client really remains the same or does not change very significantly. I think enterprises also have kind of understood that point quite well in recent times. Now they also understand that, okay, just asking for flat discounts or pushing the provider back is not going to help, right? Ultimately, if the cost for the provider is going to go up, ultimately they're going to face it sometime now or later. So they're also getting into those more productive conversations where the discussion is, okay, not just about let's go talk about a 5% increase or decrease. Let's talk about having a more productive solution as to how can we mitigate those rate increases, right? Maybe 6 months down, 1 year down the line, what is it that we can change fundamentally so that our overall cost of ownership remains the same or reduces, right? So the conversation is definitely pivoting to those situations now.
Yeah. And really what you're talking about when you say P times Q, the price times the quantity is what really makes up the end invoice. And if you know the price is likely to be going up, the other big or even potentially larger point of the conversation, if you make the quantity go down, so the number of labor resources, that's probably going to be the way that we see our way through this challenge for us over the next few years. So, all right, let's go on. I think we've got one more slide here, and then we're going to jump into the rest of the Q&A.
Got it. So another set of initiatives that we are again commonly seeing in the market is how is some providers or some enterprises using gain sharing to as a win-win arrangement to not just to retain their competitiveness as well as improve their profitability, right? So one of the questions that enterprises rather typically always ask us is that, okay, the provider committed a 20% reduction for me over a 5-year deal term and they've got it, but how do I incentivize my provider to actually go above and beyond that, right? So the answer lies kind of having some sort of a gain share mechanism. A very common example is that, okay, the provider committed 20%, they achieve that. Let's say you promote them to go up to 30%. Now how will the provider be incentivized to do that? So let's say the additional 10% that they were able to realize, the 70% of the benefit of course gets passed on to the client, but the provider gets to retain some of that, right? So it's basically you part away some of the gains that you make to the provider to kind of incentivize them further. And there are also these constructs where we're seeing that the fees is kind of linked to achieving a certain business impact, right? A very common example of this being a tail end spend reduction, right? For example, if I, as a category spend expense management organization, is able to reduce my tail end spend by 20% and 20%, then would I be entitled to, let's say, a part of it, or would I be able to make more money than I was actually allowed to make? Those are some discussions. Again, it could also result in conversations around higher collections in contact center, right? For customers who defaulted, those who would be they would be undertaken by the contact center vendor and try and collect whatever the losses were. So whether they're able to collect it or not, if they're able to do it, of course, the vendor makes more money. Net, I think we are seeing some cases where providers and enterprises are agreeing to some of these gain sharing based initiatives or gain sharing based incentives to kind of have more skin in the game for providers.
All right, fantastic. All right, so we've got lots and lots of questions. I'm going to start to peel those into this discussion here. I wanted to give David just a quick chance to talk a little bit about the membership that you offer, or the type of work you do with clients. If you could do that in less than 60 seconds, that'd be great.
Yeah, thanks, Michael. I managed to find the mute button as well. So we have a number of offerings for enterprise customers, and the one that I'm directly involved in is outsourcing excellence. So we work with procurement leads and sourcing leads and really help to focus on their sourcing strategy, provider portfolio, solution design, and risk management. And then we team up very nicely with Ricky and the team in terms of pricing analytics as a service, and we work together. So we're really able to help procurement teams understand their pricing, the baselines that they're working on, performance baselines, but then also go further in terms of strategies and risk management. And then on the right, we also work on a number of projects, helping clients really sort of take rapid cost out or build their longer term strategies and their location strategies as well, and their provider rationalization if that's part of their strategy. So we've got lots of offerings that really focus around enterprises and the procurement and sourcing team. So we'd always be happy to have a conversation about how we might be able to support enterprises moving forward.
And Ricky, you talk about pricing.
Definitely. So but it's something that we did last year was kind of pivot to a more of a subscription-based model, and we've seen immense success coming out of this. So we started offering what we call as a pricing analytics as a service, which spans across the entire global services space, covering both the entire sort of IT applications, IT infrastructure, as well as the BPO market. And there's some indicative functions that we've listed here, but again, by no means are they exhaustive. I mean, just by the virtue of our existence for the pricing team in existence for over 11 plus years, we've been tracking roughly over 300 different types of roles and over 1,000 plus skills across 50 odd locations and 40 odd sub functions. We've also not started in that. We've also matured a lot in terms of tracking more resource unit or transaction based pricing, be it on a per server, per storage, and all of those complex metrics. And net, we are covering nowadays. We are in the based on the last 18 months data, we're covering over 375,000 data points from the last 18 months alone. I think the good point about something which I really like about this is that the whole membership is not just about, okay, this is your data cut and go back and use it to negotiate with your vendors, right? It's just not restricted to that. So we offer something which we call as a pricing consult or pricing analyst stars, and this has been immensely useful as some of our clients have articulated to us, right? So one of the examples I can probably cite is one of the leading healthcare providers in the US coming back to us saying that, okay, our vendors have come back to us with asking for a 30% rate increase in CC in the CXM space. How do I manage that? What is it that my peers are doing? Are my peers agreeing to a 30% rate increase? So kind of it goes back to the conversation, right? Okay, let's baseline. Let's look at what you're currently paying. If you're paying too low, then probably a 10, 15, 20% number increase is justified. But if you're already towards the upper end of the quartile or upper quartile, you probably need not agree to that 30%. And how do you negotiate, right? How do you go back to the vendor? So there's a lot of support that we provide over and above just providing the data cuts. So yeah, there's a lot of value that we believe enterprises can derive out of these memberships.
Wow, 30% increase. I heard that, Ricky. That's going to keep your teams busy if they're really kind of talking about those kind of numbers. All right, let's switch this to specific questions from the audience here. Anurag, question between the business verticals. Where are we seeing the most activities in an industry vertical? We've talked a lot about regions. We've talked a lot about roles, but let's talk about verticals.
Sure, Michael. So I can share my views, and then I think Ricky may have a point of view as well on this, and David. So I think the biggest stresses we see are in the manufacturing, oil and gas sectors, given these were fairly heavily hit during the pandemic. So they have had the most activity around, being more cautious around their cost or spends, but also conscious around their rates, right? Rates that they're paying. I think some of the industries where we are seeing lesser conversations may also be worth talking about. So I think healthcare had a fairly good time. I think technology, internet, media industry had a relatively good time. So they were seeing less conversations there. But I think increasingly what we're seeing is that these companies are also getting more conscious around their spend. So it's not as if there are no conversations in these industry, but there are some conversations happening now. Ricky, David, over to you. Anything you wanted to add?
I'll try and take a different point of view to this, Anurag. So I'll try and talk about which sectors are we seeing maximum requests coming in from, where providers are asking for rate increases, right? And you rightly said BFSI, healthcare, oil and gas. These are areas where we are seeing providers going back to clients for rate increases. Transport and hospitality, even though they've recovered and probably going back to where they were prior to COVID, but the conversation has still not come to a point where the providers have already started asking for rate increases. But BFSI, in the entire BFSI space, be it insurance, capital markets, retail banking, whatever it is, similarly in the life sciences and healthcare space, these are areas where we actively, in fact, clients from these sectors coming to us asking for, okay, how do I manage these rate increase requests coming from our providers?
All right, I've got another question here. Is it actual increases in jobs, or is the same jobs being hunted by multiple players, resulting in shortage and salary increases? So I was talking to our marketing team, and we were talking about how we wanted to position one of our upcoming webinars, and we were talking about the talent war and the talent one. I think it's a little bit of the talent winning here, so to speak, but I think really the reality is we have an upsurge in demand. We've got changing demographics that are, we got the baby boom generation starting to return. If you look at the number of workers that are coming online, i.e. coming out of schools right now, the demographics are much, much lower than they were 5 or 10 years ago. So there's a combination of that. There's also the work from home the COVID actually instigated several people or several dimensions of the challenge as well. People not returning to the workplace because they changed their life cycle or lifestyle, or that they chose to stay home with their families. So all those things are happening, but regardless of all the what's causing it, the number of jobs is at a high pace. The numbers that David showed for the UK, the numbers I showed for the US, has never been there before. I mean, the number of job openings is just purely higher than it's ever been. The number of unemployed is starting to go back to pre-COVID levels. So it is a demand situation and a shortage of supply. It's not just people saying, "Hey, I want to leave," and that creates more attrition. That creates a company-to-company imbalance, but it doesn't create an economic imbalance. I don't know if anybody wants to add to that. You can steal from your neighbors, but you can only do that for so long.
I think, Michael, to some extent, that double counting in terms of the multiple players, having the same openings has existed for a while. But I think even if you discount that, and because that has sort of been, you can assume that that effect is the same. Even then, there is a definite step up in activity and shortage of talent. I think that's the point we're making.
Yeah, I mean, go ahead, David. Sorry.
So all I was going to say is I also think that what we're seeing, and this is specific to sort of customer experience management area, but we're seeing there has been a big peak in demand as retailers have gone online and needed extra support. Governments have ramped up hundreds, thousands of agents to be able to support COVID lines, etc. So that's pushed the demand up for that area. And then we're also seeing, because lots of organizations are trying to push their digital transformations, there's a big demand for technical talent out there as well. So that's also causing a supply shortage as organizations are looking for where they're going to get that digital talent from.
Okay. All right. There's a ton of questions we are not going to be able to get to, but we'll try to go back to you individually and as a follow-up to this webinar. If you're interested in the rate conversation, please let David, myself, Anurag, or Ricky know. We'll be trying to help you on that. If you're interested in more information about some of our thoughts on that, certainly reach out to our website, and you can see we got all kinds of research-based content, including blogs, which are free. And then also, you can certainly email us or reach out to us on LinkedIn. So guys, I want to thank you for your time today, and let us know how we can help you.